Hello, my name is Michael Glass from emini-trading-coach, where we focus on finding and identifying high probability trading setups. Before we begin our video, we always want to start off by disclosures. Any symbols you see today should not be inferred as a trading recommendation, no matter what form of investing you choose, stock, forex, futures, options. They all have a level of risk associated with them. You can lose all your money. Any back testing we do today is just to show the probabilities of future results. They are not guaranteed, and any investment decision you make is solely your own responsibility. Trade at your own risk. So this is our weekend wrap-up for February 26, 2011. When we look at the week that was, we see that all three major indexes ended on a down note for the week. We had 3 up weeks in a row, but this ended that little streak. The S&P fell 1.7%. 9 out of the 10 major sectors fell. That one sector that did not fail was energy, which is highly associated with oil. And the reason that is because of the geopolitical concerns over in Libya, which can affect oil production, although Saudi Arabia said they would pick it up. But that's one of the main reasons why this is taking a little bit longer drawn out, having more impact on the market than Egypt, because Egypt wasn't as involved with oil production. So that's why this one's having a little bit more of an impact. We really didn't have anything on the corporate side. Most earning reports were disappointment, and as energy and oil is going up, some of the precious metals were being lifted. We also had fourth quarter GDP revised downward to 2.8%. And a lot of this has to do with all of our states being, heavily in debt and not spending and cutting their budgets. And so GDP was lowered for the fourth quarter. Next week, we don't have any key earnings, but we do have our jobs numbers coming out next week. We got ADP on Wednesday, and we have non-farm payrolls on Friday. So we do have some catalysts coming up this week, but we got to wait for them on Wednesday and Friday. As we look at our key technical analysis points, obviously we are still in an uptrend that has not been violated. The swing high that we put in is 1344. Resistance, right now we are sitting at the 10 exponential moving average, but we'll see that when we pull up the charts. And support's going to be around 1290. And so what's going to be interesting to me is to see if we can break through this 10 exponential moving average to get back up there to the swing high of 1344. So let's go ahead and pull up the charts and take a look. Okay, we're going to start off with the S&P 500 on a daily chart. And as we look at it, obviously you can see our great up move from November-ish. Of course, we've been on a long uptrend there, but November is really when we last really paused, had a nice pullback. So you can see for a while there we were riding the 10 moving average and the 20 moving average, and we finally did break through that 20 moving average down. And so now this is why we're saying the 50 moving average is acting as support, and our next swing low is actually down here at 1273. However, the reason why I said 1290 is if we look at this little swing high, which is in that 1290 range, and that's kind of where we wicked down these past couple days. So that's why I'm saying this may hold up as support. But ultimately, I think the 50 moving average is going to be where we're holding up support, and then we have additional support with the swing high and the swing low right here. So we do have support underneath us, and of course, for the past month we've been talking about how long we've been overbought, and at least we finally did get pulled out of the daily overbought range, and then the move on Friday pulled us right back up to the 10 moving average, exponential moving average. So this is what we're saying, that once we break here, we've broken the 2 big candles come down, and if we break the 10 moving average, we'll probably be halfway through our big push down, and so that should give us some momentum to go up and retest our 1344 swing high. Again, as we talked about our indicators, they're all coming out of overbought, but certainly there's still more room to pull back. Let's go to our weekly. And the first thing you'll see on the weekly is that at least we had a red candle. Not too many red candles as we move up from our low here. So, and our weekly came right down here to the 10 moving average for support. So that's certainly interesting. However, our weeklies are still overbought. Our weeklies are still overbought and show more potential for a pullback, maybe all the way down here to the 10 moving average once again. Let's go to our monthly chart to get a bigger snapshot And we can see our month of February is turning into an inverted hammer here a little bit. Of course, so was January, and we still went higher. So it's not the death nail, but it's always something to watch. So we can see our monthly are getting up here to overbought. Not quite there, but basically overbought. MACD's catching up. Still has a little bit more room to get to overbought. RSI is overbought. So again, we have to be cautious. Still cautiously bullish. Still like to see us move up there and retest the 1344. But as we said last week, a pullback seems to be in line. And with us not having any catalysts this week until Wednesday, it'll be interesting to see what happens on Monday and Tuesday. Especially when Monday really typically has been driven by overseas news. So anything out of China, any more news out of Libya can affect the market on Monday until we can get some news on Wednesday and Friday. Okay, in addition to looking at the S&P 500, we want to look at some of the industry leaders to give us a gauge on the market, again, to see where they're going on. And so we're going to start off with Apple, certainly an industry leader, market mover. And we can see, remember the S&P 500 did not make it down to the 50. We can see Apple did wick down here 3 times, and then we bounced. That bounce was a nice gap up here on Friday. But we did find some resistance in at the 20 moving average, So if I was watching Apple, what I probably would be doing is putting an alert. Notice this inside bar we have here matches up with the wicks we have from over here. So I would put an alert right above this 349.25 price level. We got an acceleration. We're a little overbought. But if we can break above this inside bar, that's halfway between our big push down. So that's where I would want to possibly consider to go bullish. Now, I'll be honest with you, I was in this trade on Friday, but for a continuation of a move higher to retest the highs, I would watch for above 349.25. Another industry leader we can look at is Amazon. Let's take a look at that. Blow up the screen just a little bit. And here we can already see a double top pattern here on Amazon. Maybe even a head and shoulders pattern going on around the 173 price level, which is kind of where we're bouncing. So that's good. But you don't see that move up that we saw in Apple. So I would be watching this one. I don't really see a trade on this one. I'm not ready to go bullish, not ready to go bearish on this one. But you certainly can see on the daily, we are in an uptrend. We've got a double top going on here. We have an M pattern setting up here. We got a head and shoulders pattern up here. So Amazon's one that I would put on the watch, but I wouldn't be trading it quite yet. I would like to see a definitive break lower, make a lower swing low here, something going on. Let's go to Google. Google's kind of got the same thing going on. Before we blow it up, we can see it actually looks like we've broken the 50 moving average with Google. So let's increase the size. We certainly are wicking at the 50 moving average, and we have wicks below the 50 moving average. So Google is another one where I don't see a definitive trade right now. Just a lot of sideways choppy action. So I would stay out of it. So we're not looking at our smaller time frame to get agreement with the larger time frame because I just don't see the trade yet. A new industry leader from 2010 would be Netflix stepping into the park. Look at that beautiful uptrend. 50 moving average holding up as support as we have moved on up. Now, our PPS has given us a down arrow, but I would definitely say until we break the 50 moving average, I wouldn't go bearish. Matter of fact, it's looking like our acceleration wants to go back. It's decelerating, and it looks like it wants to swing back up. You can see for the past couple of days, we've had low volatility. Now, what would interest me, if you really wanted to go aggressive, because I can see that where our volatility is tightened, we do have a squeeze play setting up. And so it is probably going to, because it's a big mover, it probably is going to move big one way or the other. So you could do a Bollinger Band pinch play on this one if you really wanted to. However, I would probably wait for a definitive break, either of our beautiful uptrend, the 50 moving average, possibly like Apple. If we break back above this inside bar, you could consider going bullish. back above the 20 moving average. And again, you'll find that if we get a Bollinger Band breakout. Can't forget Goldman Sachs. That's just some of my alerts going off now that we pulled up Goldman Sachs. And you can kind of see here just some choppiness, no real definitive trend. Sure, we're in an uptrend, sure. But in recent weeks, days, we're just seeing some choppy action. So I don't really see a definitive trade that I want to set up. Even if we broke the wick lows, we've got something going on here. And then we got the 200 moving average right below it that's going to act as support. So I don't see a definitive trade on Goldman Sachs. Moving on to our educational portion of our video using the book Trade Away to Financial Freedom by Dr. Van Tharp. And he continues his theme that he talked about back in the beginning chapters. Those of you who've been with us for a long time know we've been going all the way through this book. And one of the gentlemen he was doing a seminar with, Tom Basso, basically explained that the most important part to trading is to know where you're getting out and how to position side into the trades. And so a person in the audience said, well, so if you're saying that the most important thing is to know how to get out and how to position sides, that you could consistently make money no matter where you get into the trade. And Tom Basso said that he could. So he did some testing where he did some entries on coin flips and some random entries. And no matter what happened, even if he got out of a trade, he automatically got back in on a trade based upon a random signal. And he showed that he consistently made money even using $100 per contract and slippage on commissions. And so, again, this is one of the things. People focus so much time on getting into trades and finding high probability trade-outs, and that's good. But you also have to know how to get out of a trade. I'm watching some people that I highly respect, and they are long holders, which is fine. You know, they want bigger targets, which is fine. However, what I found is that sometimes I'll do a little bit better than them because of my position sizing and because of how I take exits. And so, and what I'm referring to is because they're holding for 3-4 points, and I'm taking profits along the way. I've seen where they've been up 2 points and then they get stopped out at a 1 point loss or a 2 point loss. Whereas I'm saying, okay, this is nice. I'm going to take some off at a point, take some off at 2 points. And, you know, you certainly do want to let some contracts run, but you got to be smart about it. And it doesn't make any sense to me to be up 2 points, be up well over a point, and then to be stopped out for a loss of money. So you guys know we're on Facebook, YouTube, and Twitter, emini-coach or emini-trading-coach. We've got a great page on Facebook about high probability trading setups. Check us out there. And, you know, all of this is to try to introduce you to our philosophy. So we do have a free 5-part video course on identifying and trading and developing your own high probability trading setups. You can sign up for there. And we do have a whole video curriculum for you on the building blocks of trading, on the components of a good trading plan, and many different trading setups and market internals that you can buy for $250, not $3,000, $4,000, $1,500, but $250. Because we believe you can buy all the sizzles that you want. You know that's how we feel, all the indicators you want. But until you change and develop a trader's mindset, you're not going to change your trading results. And so our real focus is on signing up for our mentorship so we can work with you, develop one-on-one, handheld, and develop a personalized trading plan to help you have that trader's mindset. We still have our great relationship with Global Futures, 20 free trades if you sign up through us, intraday margins as low as $300. And check out our Forex blog, giving you the same great technical analysis on Forex. So, as we just said, it does make a difference in what you buy, what you're looking, what you're watching, if at the end of the day you don't pull the trigger. And we at emini-trading-coach are all about helping you develop that trader's mindset to be a successful, profitable trader, pulling the trades and being able to manage the trade each and every single time. Thanks, guys, and I'll see you next time.